forward. So yeah, it's definitely designed to be used with your customers.
Now, when you get a printout first time and it looks Greek, what I do is in my office, I take one of your printouts, I send you a clean PDF, and then I will scan one and I will mark the daylights out of it, right? And I will get it all so that you can pick it up and read it so you can see where all these columns interlace. After a couple of times, I probably won't need to do that anymore, but the first couple of times you want to make sure that you point out all the sales features.
All right, so we're going to talk about Asset Care 4 now. Asset Care 4 is if they don't have a lump sum, they want to do ongoing payments. I got to tell you, Asset Care 4 is our fastest growing product. In 2015, in one calendar year, we doubled our app count on this product line by doing head-to-head comparisons with traditional long-term care. And so I've got a piece I want to share with you in just a minute on that. But here's the concept. So once again, we're going to start with a base contract first, a death benefit. Here you can see we're going to take the death benefit out. We're using 4%. We're going to take the death benefit out in 25 months. That's because this was a younger couple. On this particular PowerPoint, they showed a couple that was 40 years old. And so they bought a death benefit of $100,000. And if you can get out 4% per month, that's $4,000 per month per person. Right? 4% of the death benefit. So you can see at their age, it's very inexpensive to buy the base contract. Only $1,000 a year, whole life guaranteed, never to go up. So they definitely want to go through the base, and then they want that unlimited lifetime rider. So we could show them the double. I don't like that. Let's just go past that. We want the lifetime rider. So here's unlimited lifetime benefit starting at $4,000 per month for 2 people. And it's got 3% compound inflation, and the premium is $2,100 a year. So you've got $1,000 for the base, $2,100 for the rider. You've got a total of $3,100 a year, guaranteed. It can never go up. And look what you just did. You went to a younger couple and gave them unlimited lifetime benefits. For 2 years it's level, and then they go to the unlimited lifetime rider that's got the 3% compound inflation. If they never need it, they've got the $100,000 death benefit, or if they wanted to walk away, there's going to be cash inside this contract as well. I'm going to show you that in one of the handouts. This one, the ongoing payments, we go all the way down to age 20, but to be a little bit more realistic, we recently just changed it. The lifetime rider now can be added at age 35. So we rarely see people in their 20s or 30s. I would say usually the majority of the Asset Care 4 is written from 40 up. But it's got guaranteed cash value. If you don't want to pay every year forever, like traditional long-term care, what did traditional long-term care offer in the past that most companies have gotten away from? Paid up plans, 10 and 20 years, right? We all offer that as an option. You can do paid up plans. If you want to do a paid up plan, you can do it in as short as a 10-year, or you can do it in a max of 20 or anything in between. So if you've got someone that's 52 and they want to be paid up at 65, we'll do a 13-pay, So it can be anything from 10 through 20 years for the paid-up plan, or pay-as-you-go. Now, this particular one, I mentioned that we have a side-by-side comparison. This piece right here has been updated.
Okay.
This one's got a little bit more information on it, but the concept is the same. So I want to walk through this with you. So we've got a couple. We've got a couple here that are age 55. And we've got Asset Care 4 in the middle, and we've got traditional standalone on the outside. And we said, we want a $5,000 a month benefit. All right, so we're using the same monthly benefit. Now their max coverage was 5 years. We're going to show unlimited lifetime benefit. Now you can see they have a 30-day deductible for everything. We've got 30 days on home care and 60 days on everything else. So a little bit of a notch for them, a big notch for us with unlimited lifetime benefits. Both have waiver of premiums. Now, if you stop right there for a minute, on just the first couple of lines, the long-term care. Now if you go down to the bottom, and you look at if you just cheat and go down to the bottom and look at the annual premium, you look at well, they're at $3,400 a year, and you're at $4,200 a year. Wow, you guys are a lot more expensive. What? We're done. I mean, why even bother to show this? You're not in the ballpark. remember Paul Harvey? You remember what his line was? And now you know the rest of the story. Let's take a look at the rest of the story here, because I think not only are we in the ballpark, I think we're going to show you that this makes more sense. So we already started on the top by saying we're both using $5,000 a month, but we've got unlimited lifetime benefits compared to their 5-year max. Their premiums are not guaranteed, so they can go up. Look at the cash surrender value at the end of 10 years. You have 0 with them. We have guaranteed surrender value in year 10 of $22,000, in year 20, $53,000. And we have a death benefit of $125,000 if they don't need care, they have 0. So now let's take this another little different angle on this. In 10 years, at $42.60 a year, they paid $42,000 into this contract. At the end of 10 years, if they decide they don't want it anymore, they can walk away with 22, so their net cost was only $20,000. And it can't be any more than that, because it's a whole life chassis and a non-cancelable rider. There can be no rate increases. They had $3,400 a year, so in 10 years that's $34,000, assuming no rate increase. It could be worse. And at the end of 10 years, $34,000, if they want to walk away, they have no cash value, so their cash outlay is $34,000. Can you see what's happened with these contracts? In a very short period of time, even if we were a little bit more initially, the fact that we're guaranteed never to increase is huge, because with the guarantees inside the contract, our net cost in just 10 years is already less. So it's more cost effective. And what's the other selling point here? Live, die, or quit, something's always paid out. If you never need it for care, what are they getting at death with their contract? Nothing. We've got $125,000 income tax free to the family. If you want to walk away, you put all that money into premiums, what do you get back? Nothing. Ours is going to be substantially reduced because we have guaranteed cash surrender value in the contract. All of a sudden, when people see the side-by-side comparison, this clicks, this makes sense. That's why in 1 year we doubled our app count in 1 year, because we went back to agents and said, go back to everybody you quoted in the last 12 months that didn't buy. And just ask them a question. I know you're interested in long-term care and you said you could afford the initial premium, but I noticed we never did go ahead with that policy. Refresh my memory, why was it again? And you're typically going to hear, well, I was concerned about future rate increases, and what if I never need this? What if we can guarantee the premium is never going to go up, and even one step better? I've got a product that'll that says no matter what happens, something is always paid out. Whether you need it for care, or you change your mind, or you die without using it, something is always paid out. Now we have their attention. That's how we've gotten so busy in this marketplace in such a very short period of time. Up here in front, did you say you had a question?
Yeah, basically, these are 125,000 minimum, that's correct?
It varies. 100,000 in the states that allow, 100,000 is typically the minimum death benefit. This was just, 125 is just because that gives us 5,000 when we use the 4%.
Am I right in assuming that they do not do cognitive tests on this product?
You would be incorrect. So on the underwriting, whenever we do the life long-term care combinations, there's an application. So there's a number of health questions on the application, and then there's always a phone interview. And the phone interview is a registered nurse, either from EMSI or Life Plans, one of the approved services. And a registered nurse from one of those places will call and say, all right, well, Ed, this is Gary, I'm a registered nurse from Life Plans. I see you bought Massacare 4, we need to go through your health history, is this a good time to talk? And you say yes or no. And it's all right, so they're gonna review your health history, and they're also gonna do the cognitive test, the memory test. Okay, so that is, now, on the annuity side, which we're going to get to in just a couple of minutes, on the annuity side, it's a much shorter application. There's only a handful of questions, 5 or 6, depending on which product. And then, if they don't want the rider, if they want the base only, there's no cognitive test, there's no phone call. And so we've got a marketplace. Now, this product in particular I like because it goes up to age 85. There's a market from 81 to 85 where we are just taking large amounts in, because now they found out they can still get long-term care and they don't even have to go through the cognitive test. Typically they're approved within 24 hours unless there's a major health issue. So this is Asset Care 4, the side-by-side comparison. Now this piece says not for public distribution because it's on our stationery talking about another company's product. You can do the same thing on a yellow pad. You can get a quote for traditional long-term care, talk to Jim and say, well, this is where we're looking at for the long-term care. This is what they were gonna be paying for, this is the benefits. Show me an AssetCare 4 that's comparable. How would you go side by side? They'll get you the illustration. You can do this, we just can't put it on our paper. Does that make sense? So AssetCare 4, and all of those numbers come right off the illustration. This is the AssetCare 4 illustration. We're not gonna spend a whole lot of time on it because I wanna get to annuities and we're getting short here. The main thing to point out here, you've got a couple that's 55 years old, once again, individual or joint. Now this is back to non-qualified money. This is non-qualified money, so remember, it's any two people with an insurable interest. Usually a husband and wife, but any two people with an insurable interest. So they got the death benefit, then they got the unlimited lifetime rider. This shows the death benefit, taking it out over 25 months, you got $5,000 a month benefit. Your next page, the ledger, you can show guarantees, premiums. You can look at guaranteed surrender values. So that number that was on that comparison sheet, there it is, $22,592. So it's right off of the ledger. You can do the same thing with the cash surrender value in year 20. It's got the same language for the rider, that it's non-cancelable, it can never go up. One page further back, it's got the cost of the premiums. You can buy them as a lump sum, or you can do it annually. And you can see here that the 3% compound inflation lifetime rider would be $4,200 a year. So $4,200 for the base, 20, what was their premium from 25 and 42, so they're a little over 6. They're about $6,700 a year. Guaranteed never to go up. So this is AssetCare 4. Anybody that if you quoted in the last 12 months, if they didn't go through with it, find out why. Come back and take a look at this. This would be a good way to approach that. Let's get off of the life side for a minute. There is, I mentioned earlier, this number's a little old. We're over $2 trillion. As of 2013, there's over $2 trillion in annuity assets in the United States. A lot of people bought annuities thinking that they would benefit for two reasons. Number one, the accumulation phase, a nice safe place, tax deferred build up. And then number two, distribution phase, you can get income for life. Well, a lot of these people have done pretty well. They don't need it for an income. Gallup did this poll back in 2009, and they found that, you can see that 3/4 or better are saying, don't really need it for an income, it's there for emergencies like healthcare, I don't want to be a burden on my family. And annuities are typically the place they would go. So what we want to do is we want to show them, look, even though we're at historically low interest rates on a fixed product, and we have surrender charges, 9 years, it makes no difference. We're still doing a tremendous amount of annuity long-term care business because of two reasons. Number one, the change in the tax law, the PPA, and number two, the built-in value added we have with these products. So let's talk about the change in the tax laws first. So the annuity care line, we've got annuity care 1, annuity care 2, and indexed annuity care. Talk about the change in the tax law first, the Pension Protection Act. I have a copy of this page if you want it. Here's the concept. There's all these old annuities out there. So here's somebody that put $50,000 in years ago, maybe decades ago. And after the surrender charge, sometimes they keep with the same company, but more often than not, they would move it to another company and get a better interest rate and then go through this process. So over the years, over the decades, they picked up $100,000 of interest. So today it's worth $150,000, and they say, I don't need it for an income. This is the asset they were thinking about using for long-term care. If they would take this out for long-term care, it's the old LIFO accounting. All of the gain has to come out first. So this $100,000 of interest comes out first, they pay a tax on 100% of it. Not very effective. Here's where the government helped us. They can do a tax-free 1035 exchange, and here's the key part, into a PPA compliant annuity. All three of our annuities are PPA compliant. The Pension Protection Act. Now, it was passed in 2006, became effective in 2010. Here's the deal. If it's a PPA compliant annuity, if they want to pull it out for long-term care, it comes out 100% income tax free. All of it, principal and interest, no tax. So now they took their old product, a CD, which was taxable, and they moved it into an annuity, so at least they had tax deferred buildup, but they knew at some point they were going to take it out and pay a tax on it. Now they move it over here, if you need it for care, it's all tax-free, 100%. So the first question is, why would we not want to talk to everybody that we know that has old annuities and say, you've been retired for 5 years, do you need this money for an income? If you do, don't touch it, leave it there, because they're in a good place, they can get a lifetime income. But if they don't need it for an income, it's, well, have you thought about long-term care for you or your spouse? Is that a possibility? You might need that. Show them it's a distinct possibility. Did you know you can move your old annuity into one that's PPA compliant, and now all of it, principal and interest, comes out income tax free? I'm telling you, we're doing a lot of this. Now that's just the PPA. And now let me show you what are the benefits with our product. Let's start with annuity care, or sometimes called annuity care 1. Everything in their annuity can come out income tax free in a 3-year period. So if they have $150,000, that's $50,000 a year for 3 years. Now they can't get it out more than monthly, so that breaks down to 41 to 67 a month, I think it is. But you get everything, all of your money can come out, principal and interest can come out income tax free over a 3-year period. Then we give them the option, you can put a rider on, does this look familiar? Like the life insurance. To either double your pool of funds, or what was the better one? How about unlimited lifetime benefit? And that's why I like this product. Your money first, and then unlimited lifetime benefits, typically with the inflation. This product goes to age 85. So what I like is, there are a lot of people between, our life products all stop at age 80. There's a lot of people between 81 and 85 that thought they missed the boat. It's too late to get long-term care. We're writing huge annuities, either that we're moving, old ones that we're moving, or just CDs that we're putting in here. Here's an example of somebody that was 81 years old, had an old annuity, 75,000 basis, $50,000 gain, doesn't need it for an income, but we have not been able, the agent was not able to touch it for years because they got a 3% guarantee. All the guarantees are down to 1 now. How do we move this? We can't. We can. And it's not even a problem for suitability or compliance because we're giving her something she didn't have before, and that's long-term care. So the concept was simply, we could take the 125, we could take the entire amount and do a 1035 all into the base. But here's the other thing we can do. We can split it. We said, remember, the lifetime rider you could pay for as a lump sum or annual pay. So we said, well, how much does it cost as a lump sum? Now she's 81, so there's no inflation out here. This is 11. It was 22,000. So we split it. We put 102,000 in the base, 22,000 into the paid up lifetime rider. So now we took her 125,000, which if she needed care, the first 50,000 would have been taxable. And we put her into a vehicle where now, if she needs care, she's got 3,000 a month, 36,000 a year for the first 3 years, and then it's 3,000 a month, 36,000 a year, unlimited lifetime benefit. Now, is this dollar amount going to cover all of her long-term care? Absolutely not. But now, did we just find a huge source of unlimited lifetime tax-free benefit if she needs care? So that's less that she has to come up with out of her own pocket. And this was, like I said, moving an old annuity. It doesn't have to be. It could have just been a big CD. 81 to 85, we're finding the case size is huge. I'm routinely seeing 2, 3, 4, 500,000. That's our upper limit. And just recently we asked for an exception because we had one that was like 575,000. They could move it over here and get long-term care even though they're above the age of 80. As it says right down here, if you wanted the base only, there is no telephone interview. Okay, only if you buy the rider. So that's annuity care 1. Annuity care 2. Annuity care 2 is our most popular annuity at the moment for a reason, a couple of reasons. The first reason is it's a higher payout. Everything comes out in 2 years for an individual instead of 3. So on 150,000, instead of 50,000 a year for 3 years tax-free, it's 75,000 a year for 2 years tax-free, the higher monthly benefit. The second reason people like it is, you know that rider on the life side in Annuity Care 1 that you had to make a decision if you wanted to add it, and if you wanted to add it, there was a cost for it? Well, with Annuity Care 2, it automatically comes with a rider. Automatically. You can't buy it without the rider. And you just have to decide which one. Do you want an additional 3 years, 6 years, or 9 years? So you have your base and then the rider, and here's the good part. There is no out-of-pocket expense for the rider. The cost of the rider is just subtracted internally. So what does it look like? If I had somebody that was 70 years old with $100,000, if you get your money out in 2 years, that's $100,000 would be $50,000 a year for 2 years of their money, all tax-free. And then 50,000 a year of the insurance company money with the rider, 3 more years at 50,000, 150 on the rider, 100 on their base, that's 250. We've multiplied it 250%. We've turned 100 into 250,000, income tax free for long-term care, and they took no money out of pocket to buy the rider. The rider was just subtracted internally. At the end of 10 years, if this person wanted to walk away, there was a small gain of about $2,000 in the contract. And I had somebody say, in 10 years, that's only $2,000, that's not a very good rate of return. I said, are you kidding? It's phenomenal. Because remember, they're 70. At age 70, if you're over 65, what are the percentage odds you're gonna need some form of care?
65, 70%.
70%. So if he's in the 70% that needs care, I turned his 100,000 into $250,000 tax-free. If he's in the 30% that never needs care, he still had a small gain in his contract. If he tried to buy 5 years of coverage for long-term care at $50,000 a year, at the end of 10 years, if he didn't use it, what's his rate of return? I had someone say 0. No, it's not. It's a negative number. So people like annuity care too because the rider is built in. Our most popular is, if they're older, is taking the 3-year, so it's 250%. If you go with the 6-year, that's 400%. 100,000 is worth 400,000 if they need it for care. Now there, we're subtracting the cost internally. At the end of 10 years, if that person wanted to walk away, the surrender value would be about 93,000. So think about that. We took 7,000 out of their principal over 10 years. That's 700 a year for 400,000 of long-term care benefit, income tax free. So people like this. Leverage the money without taking anything out of pocket, and it's tax free for long-term care. This one we do from 40 to 80, and because the rider is automatically included, you do have to do the telephone interview. All right? So if they're younger, we usually do the 6 year, and then, where we're quadrupling their money. If they're older, if they're already in their 80s, usually it's just a 3-year benefit, 250% increase. So the last product before we get to underwriting is indexed annuities. Has anybody in here sold an indexed annuity? About half, well, a little more than half of you. All right. If you're not familiar with indexed annuities, trust me, this is not the place to learn them. But if you have sold an indexed annuity before, then you'll like this, because what this is, it's the first indexed annuity specifically designed for long-term care. The first thing that you'll notice about this one, once again, it comes out, the base comes out in a 2-year period, so it's a higher monthly benefit. Then you have the option, you can either put the rider on to double, triple, or unlimited lifetime benefits. That's all good news. This one, once again, goes to age 85. That's why I like it, 40 to 85. Now, why an indexed annuity? If you take a look at page 18, take a look at page 18, there's a little chart in there. If a typical fixed annuity was down here and market returns were way up here, just because it's tied to the S&P 500 does not mean you're going to get these phenomenal returns. With caps and PARs, it's not going to do that. All it's designed to do is, in a good market, it should give you a slightly better return than a traditional fixed annuity. All right, so don't think that you're going to see amazing returns just because it's tied to the S&P 500. So what is it about this? What is it about this that makes it unique? Go to the middle where the staples are. And this is what makes it unique. At the time of a claim, so in this example, they put 100,000 in, and in 15 years, in 15 years, the 100,000 grew to 153,000. Now we could have just stopped right there and said, okay, you did pretty well. At the time of claim now, you have 150,000 that you can get out in 2 years. So that's a little over 75,000 a year tax-free. That's not bad. we take it one step further. Not only do they get advantage of the indexing, but we're gonna bump them up again. There's another multiplier that we're gonna use, or a step up that we're gonna use at the time of the claim. So the claim was in year 15, so we go to the first column, and you can see it goes up 1% a year, then it levels out at 15%. So 153,000 times a 15% increase, now we're at 176, almost 177,000. Now that looks pretty good because the market performed well. There could have been years in here where there was little or no gain. Now with a variable annuity, you can actually lose principal. You can't with an index. You just get a zero if it's a negative year. But there could have been zeros. If you had a lot of zeros in there, they wouldn't have 153,000. It would have been less. So we also take a look at what is the amount you put in, and let's multiply that by a factor. So you can see we start at 1, and it goes up 5% a year starting in year 11, and levels out at 50%. In year 15, it's 35%. So that turned 100 into 135,000. So even if the market had tanked every year, we still would have turned their 100 into 135,000 at the time of the claim. We do both factors, and whichever one is larger, that's the one that they get. So here, they got the advantage of indexing, so they had their 100 grew to 153, then we multiplied it again, it's up to 177,000 tax-free for anyone with long-term care. That's why people like this concept. So there's a lot of indexed annuities out there, but they're sold primarily for the income. Here, and some of them, they even say that it will double your income if you use it for long-term care. But that's still taxable. This, they've got the indexing, plus the step up or leveraging, and the benefit gets paid income tax-free. So these tend to work out even better because it's designed specifically for care. All right? So indexed annuity care, and the fact that we can do it through age 85 is huge. The largest one that I think that we had in my territory last year, Rockford, Illinois. And this lady, a little over 400,000. Now she was 84. And the agent initially called me and said, "Man, I couldn't do anything for her because all your life policies stop at 18. And I said, "What about the annuity? Where's her money now?" They put 250,000. She's a widow. They had put 250,000 in a variable annuity. It's worth 400,000. If she had used that for long-term care, that 150,000 gain would have been taxable. So we talked to her first about the PPA, the Pension Protection Act. So now all 400,000 would be income tax-free if she needed it for long-term care. And then it's got this built-in leverage at the time of care. We'll also multiply it again. And she said, "Well, with all of that, I would rather not get the rider because, to tell you the truth, I don't want to go through the cognitive." So she already admitted that she was starting to have some issues, that she wasn't sure if she was going to pass the memory test or not. So they did the base policy only. What happens if you do the base policy only? There is no cognitive test. All we looked at was the health questions. She was approved within 24 hours. It took us another about 2.5 weeks to get the funds from the other company. So there's a huge market for 81 to 85. There's a market for if you have enough going into the base that you don't need the rider, you don't have to go through the telephone interview, which means less underwriting. Here are some of the conditions. Here are some of the conditions that we can work with that I've seen declined by other companies. I'm going to give you a complete underwriting guide. We're not going to go through this. I just want to show you something that's inside that I think is interesting. A couple of years ago, we had very limited information that we would share about underwriting with the field. Then we came out with this book. And if you go to page 3. It starts on page 3, the little chart, and then turn it over to page 4 and 5, just to give a better view. We list all of these different health conditions, and we'll tell you right up front, we'll consider it for our expedited underwriting, which means no medical exams, there were no APS, we're not going to write to the physician. Just the application and the online drug check. Then we have the middle column, which is full underwriting, and then we have the decline list. So we have a much more extensive guide that we're putting out now, and then right behind that should be the build chart, the height and weight. Now I'm 5'10", I'm from Wisconsin, land of beer cheese and deep fried anything on a stick. Our underwriting is Wisconsin friendly. I'm 5'10", I could gain almost another 100 pounds before I would not qualify. So it's extremely liberal underwriting. Now, that does not mean that every case that you submit is gonna be approved, and we also are not looking for just your bad cases. We want all your cases, the good ones and the more difficult. But what I'm telling you is, with our joint underwriting, we're more competitive. With our annuities, there's less underwriting, we're more competitive. And our annuity, if you don't need the rider, we're even still more competitive. So some of these cases that you've had a hard time placing someplace else, give Jim a call. You know, let's take a look at it. Maybe there's something that we can do to get that case through. The company, One America. Now, the checks. This is confusing. The checks get made out to state life insurance company. Wholly owned subsidiary of One America has all the same financials and ratings. We have One America is the umbrella, and in state life, that's all we do is care solutions, life long-term care, annuity long-term care, that's what we do. Then we have an employee, a group employee benefits division, we have a retirement division. I don't work with them, I don't talk, the products are all handled separately. But One America is the company, state life is how you make the checks out, extremely strong financially. 130 years old, mutual company, so not be holding the stockholders, we can put profits back into the company. Record sales, for those of you that are familiar with Comdex, you know, our Comdex is 95, so there's only a handful of companies in the country that have higher combined ratings than we do. The last thing I had is, this was a lot of information, I knew that. But I wanted you to get a little something to take with you, because so often what happens with these PowerPoint presentations is, you see the PowerPoint presentation, you go, well, that makes a lot of sense. That makes a lot of sense, I think I'll do this. And then you get back to your office, and it's like, well, wait a minute, which product was it, and how does it exactly work? So I wanted you to have a couple of sample proposals and some of the sales tools. Here's the latest product overview and training guide. This one was printed November of 2015, so it's already in the process of being updated. But this will give you a little bit of a summary of some of the things that we talked about. So up in front, we've got asset care, annuity care, index annuity care, and we talked about legacy care and immediate care, those two unusual products. They're a little different, so there's the description in there. They give you all the parameters in here. So when you open this up, you can see first, we're just talking about asset care 1 and 2. Then we're talking about asset care 3 and 4, and then we're talking about the annuity products, annuity care 2. There's a little bit in here about the indexed annuity care and the legacy care. So this is a pretty comprehensive guide just to go back and hopefully answer some of the questions that I've left you with. You know, we cover a lot in 2.5 hours, but I'm not going to be able to cover everything. So hopefully if you have a question, take a look in the guide and see if you see it there. And if you didn't see it there, then once again, call Life Solutions, and there's a pretty good chance that they'll have the answer for you because they've been working with this for a while, or give Jim a call at American Senior Network. So anything that we can do to help.